All right. Welcome, everybody. This is Macro Money. I am Ilya Spivak, head of global macro at tastylive. Boy, do we have a big show today. We are, of course, mere hours, less than 24 hours from December's U.S. jobs report. This is something that is, of course, very closely watched by markets and often market moving. So we are going to do a big, deep dive into what all of this might look like. As ever, we begin with the price action. So we're not going to attempt to predict what the number is going to be because largely that's a useless exercise. Even if we knew the number ahead of time, it would be a whole other source of uncertainty to say how markets are going to react to whatever that number is. It certainly is not a given that if you were to get a high number, higher than expected, that stocks would go up and vice versa, or the dollar would go up and vice versa, or gold and bonds would go down and vice versa. Certainly not the case. So what we are going to do here is we're going to try to game this out. Well, we're going to look at what are the expectations, what are the key numbers to watch. We're going to look at how all of this filters into what is the main narrative for us, which is, of course, really since the middle of 2021. I'm so used to saying last year, but of course, here we are in 2023. So since the middle of 2021, the narrative has been Fed rate hikes and arguably now the implications of those actions for growth and for asset values. So we'll take a look at what all of this means in practice, and then we'll do a bit of benchmarking for what a response to NFP might look like across the key assets, and what are some of the scenarios for a response so that we're ready when the numbers hit the tape tomorrow. At the end of this, we'll hopefully be equipped with the tools we need to analyze those numbers as they come out, rather than attempt to predict them or attempt to trade the news itself. Predicting these things, as I say, I think is a pointless endeavor, and attempting to trade the news report itself. So actually the volatility that's activated by the report itself, I think, is a very low probability, dangerous endeavor. And what we're going to do is we're going to not do those things. We're going to equip ourselves with the tools that we need to analyze the market reaction and what it means going forward. So let's begin. For the December number, we are looking for a deceleration in job creation. We're going to come in from 263, according to market forecasts, down to 200K. That is a relatively large change. Generally speaking, the increments for change on average for these numbers have been, over the past year or so, the median has been down about 20K, about 25 on a given month. The average has been about that, maybe about 29K. So this would be a relatively large swing lower in that context, a 63K decline. The jobless rate seen holding unchanged at 3.7%, and that key measure of wage inflation, average hourly earnings, seen coming in just a bit from 5.1 to 5. Now, what has been the narrative around all of this? What is the reason we care about this? What's been going on? So, what you see on your screen here, the bars are the monthly outcomes for non-farm payrolls, which is the headline job change number in the past 2 years. I put an average on there so that you can see a bit clearer what the trend is. That's a 6-month average. And you can see here that average moves very cleanly inversely of the real yield. That, of course, is on a steep incline thanks to Fed tightening. So as the Fed has increased rates, again, in real terms, so net of inflation, you can see rates as of around the beginning of this year have gone positive, and net of inflation, money now costs more, and in fact costs something to borrow. In real terms, up until this year, money actually had negative real yield, which means that in real terms, net of inflation, you are actually able to borrow for less than zero. Now, what we have at this point is, of course, a positive cost of capital, which is something of a dampener, for understandable reasons, on economic activity. When money costs more, investing it is more of a choosy sort of decision, because, of course, it is costly to replace if it is lost. So, not surprisingly, the increase in real rates has given us a cooling in the labor market. Now, this, of course, has also been something that has shown up in wage inflation. And indeed, this is precisely what the Fed's aim has been, to bring down the stickier bit in the inflation story. There is, of course, the more, and this might be a dirty word at this point, more of a transitory half of the inflation story: supply chain disruptions, uneven COVID reopening, geopolitical issues, notably the war in Ukraine, in the supply of commodities and the echo that has on the price of goods and overall inflation levels. And then the stickier bit, which is wage inflation, which doesn't tend to be adjusting down when you have a change in the underlying economy. So the Fed's goal, of course, has been to anchor inflation expectations by taking wage growth lower. And you can see that their efforts here bearing fruit. Around February, March is where you have a topping in overall inflation expectations. That's the 5-year break even. At the same time as you have a topping in average hourly earnings. So again, the Fed, as you can see both here and here, is cooling the labor market. Now, the actual impact of this has been relatively modest so far, and the labor market remains relatively strong. The orange line there, right from yesterday's JOLTS report that we talked about earlier in the week. And here, what you have is still anywhere between 1.5 to 2 jobs for all of the unemployed in the United States. This is, of course, those people that are actually counted as unemployed. So, for example, people that are not of working age, or people that are retired, or people that are not actively looking, those folks not counted here. But for the actually counted as unemployed, there is still an abundance of jobs. Now, of course, we can get into the weeds into what kind of jobs, but in all, the labor market, having, as you can see here, clearly cooled, has not cooled by a whole lot. You can also see this in the unemployment rate, which has really held relatively steady for much of the year, right around that 3.5 level. And of course, we're expecting to see much of the same here. So the Fed has had an impact, but it's not having the kind of impact that one would say is aggressively deteriorating the situation in the U.S. labor market. So far, things are not as profound, certainly, as the very aggressive scale of tightening has been. Now, it is, of course, the case. This is something of a well-worn bit of market lore. The labor market tends to be relatively slow because hiring people, turning over labor force, both up and down, takes quite a while. And so labor markets are fairly slow, not dissimilar in this sense from real estate, in adjusting to underlying economic conditions. In fact, labor might be, to some extent, even slower. And so what you end up seeing then is a great degree of lag. So on the one hand, you have the variable and long lags to implementing monetary policy, even just in terms of its absorption into the credit space and all of the follow-on implications on activity there. And then there's the additional lag of labor being relatively slow to absorb these kinds of things, even amongst other elements of the real economy. So it could be that the relatively supportive numbers we're looking at here just don't reflect the scale of the tightening that's occurred so far. But as it stands, the labor market's still looking quite robust, despite a degree of cooling. So what has all this meant for Fed policy expectations? Well, let's take a look both near and far. So just since the last Fed policy announcement, which was mid-December, you can see that the curve has shifted only a bit. And in that time, we've had one NFP announcement leading in, but we, of course, haven't had the January release yet. So we have certainly not seen that the early December surprise. It was actually also 200K expected then, and 263K is what we got. So an upside surprise. We've not seen that really permeate into a steeper policy curve over the ensuing month. Not only that, we actually saw that curve come in a bit. But let's take a longer view that includes a wide range of NFP numbers to see what might be the influence. And the thing to take away from this near-term chart initially is the actual terminal point for where Fed rate hikes are expected to end remains June. So 6 months from now, you can see it's pointed out there at about 5%. That's June of this year. Now let's take a look at a much further away kind of curve. We're looking all the way back to into the middle of last year. And this is around when this idea that June 2023 was about right for the end of the tightening cycle began to really crystallize in markets. And what you see here is the shape of the curve, the terminal rate, have significantly moved higher, but where the cycle actually rolls over from hikes and into first stasis and then cuts remains generally the same. We are still looking for a topping in June of this year. Now, this is important because it gives us a single point of reference to look at how policy expectations have been shaped by the recent flow of payrolls numbers. The first takeaway here clearly is that over the course of essentially 6 months and a range of various employment data numbers therein, we've not had a real meaningful shift in when the Fed is expected to be done. Rather, we've had a shift in the scale of tightening, and you can see most recently, it seems to have stabilized. So the Fed and the markets appear to be of a mind. This, of course, raises the question of whether this jobs report can really be expected to have any influence on the Fed outlook, or if this is fairly well baked in. And immediately raises the idea that if there is going to be a strong market reaction, and that market reaction probably necessitates a really significant deviation from policy expectations on the Fed, or from a significant deviation in the jobs numbers from what is the baseline forecast. Now, how have expectations for June, since June is apparently the point to end all points, the inflection level here, since that's apparently it, what is the recent outlook for June? Well, you can see it's been quite stable at about 5%, give or take a few basis points, since November. And so, indeed, this reinforces this idea that the markets might be relatively well conditioned at this point for what's going to happen, or at least what the Fed thinks is going to happen, and what the markets agree is the path of least resistance. This is not to say that anybody's on autopilot. Circumstances can, of course, change. But now, for the past several months, we've been basically idling. And the incoming information we've had on payrolls, there's a pair of reports within that stasis there between November and the end of last year. There's also all kinds of other intervening economic data that approximates official labor market figures, be they the ADP report we saw today, employment indices inside ISM surveys and PMI surveys, the weekly jobless claims numbers. There's a whole lot there. And you can see with all of that stuff hitting the market, we haven't really seen Fed expectations dislodged, not for when the rate hike ends and not for where it ends, approximately. Now, there are a couple of ways to think about this then when we look at what scenario analysis for the release could look like. First, we would say, okay, well, there's a really high bar for a surprise. It would have to be a dramatic one, because clearly we had surprises along the way here, and they didn't really generate a major shift in expectations. So if we are going to get a meaningful move, there would need to be a significant deviation on one of the three key numbers: the unemployment rate, the non-farm payrolls number, or the average hourly earnings, the wage growth number. Absent that kind of thing, we would be looking for what the passing of this event risk unlocks in terms of the market's inherent sort of path of least resistance tendency. And that would be telling in its own right. So we would look and say, okay, if the number is about in line or close to in line with expectations, close enough that the Fed outlook is not dislodged, where do markets default? Do they default risk on? Do they default risk off? In that risk on, risk off backstory, how do assets relate to one another? Is the dollar up with bonds or yields? Is the dollar down with gold or up with gold? How does the interplay between stocks and gold and rates and the dollar show us where the market's head is at, what kind of world the market thinks it's living in? And that should be very telling, even if the release itself is basically as expected. So, what is the likelihood of a surprise then? This is the Citi U.S. Economic Surprise Index. This is from Citigroup. There's two things to take away here. First, at the beginning of the year, you can see big numbers, both up and down, both positive and negative, which means that markets are at first surprising substantially higher, then substantially lower relative to economists' expectations for U.S. economic data outcomes. Importantly, these numbers in this index are also scaled by the volatility that the number surprises generate. So you can really see in the first half, in the first sort of 3 quarters of the year, there's a lot of reactivity in the face of data surprises, both positive and negative, and those surprises are meaningful, significant deviations. So the markets are uncertain about the economic outlook and fine-tuning their expectations. You can see in the fourth quarter, those surprises become much more shallow. And most recently, they've flipped negative. This tells us that scope for a substantial surprise is perhaps not huge. Markets appear to be relatively well acquainted with where they think things are going, and reality seems to be playing ball with those expectations increasingly in recent weeks and months. There is, however, a slight bias in the direction of a downside surprise, which might be emerging. Now, what does this mean for the likely response? Here's some benchmarking. Over the past year, this is the past year of NFP releases, and of course you can see here, we're looking at the December number to be released tomorrow. So when you see December of last year on this chart, that's the release that came out that month, not the month of the data being referenced. That was the November number that came in at the beginning of December. So what you see here is that for the most part, NFP has tended to surprise higher over the past year. There was certainly an ugly outtake in January, but what you're looking at here for the most part, and August was perhaps the most dramatic example, in standard deviation terms, what have been the surprises relative to expectations? And you can see that generally there has been a tendency to surprise on the upside and by a meaningful amount. And the response that we've seen, the second sort of mini chart there, is the average response in percentage points from the key assets within 6 hours of release. So essentially over the course of the trading day, give or take. And you can see the strongest responses are from rates. Not surprisingly, as the data has surprised more to the top side, rates have tended to react positively because these things have encouraged Fed rate hike expectations, and stocks have reacted negatively for that same reason. On average, you can see gold and the dollar have not been very reactive. That doesn't mean that, of course, they haven't been reactive to individual releases. They certainly have. But on average, you can see, because there tends to be this push and pull where both gold and the dollar have the largest moves when yields and the underlying asset move in the same direction, we're not seeing a strong response. In the dollar's case, it's this push and pull between the dollar being both something of a safe haven asset and something that benefits from higher yields. With gold, it's something that is undermined both by dollar strength and higher yields, and on the flip side, supported by the dollar weakening and yields weakening. So when the dollar and yields move in opposite directions, gold is stuck. When risk sentiment doesn't give a clear read on the dollar because, say, it is risk aversion, but yields are going down, or it is risk on and yields are going up, the dollar can have a muddied response as well. So very near term, the risk seems to be for a small downside surprise, maybe, whereas the history of the past 12 months has been to favor upside surprises, which, by the way, is consistent with the sort of shallow upward area here before it flips negative. And the most reactive parts of the markets have been yields, so the bond market, and to some extent stocks. Armed with this information, we can look at the price action and see what has been the path of least resistance, both near term and even more immediately just today. This chart is one that we've looked at quite a bit. This has on it seemingly a handoff in the market's thinking. So you can see leading into the end of last year, you have a rise in real yields and a rise in nominal yields as a function of what the Fed is doing, driving inflation expectations down. That's the green line. And these are all directly from the bond market. I should point out that here on the chart, the 5-year real yield and the 5-year nominal yield are descaled. They're here to show direction. If we were to actually put them on the same scale, then we would have nominal yields above real yields, because the difference between those two is what generates the positive 2% or so, 2.2% that we see on the green line currently. That's that inflation adjustment. I've descaled them just so we can see the direction of where rates are going versus where inflation expectations are going. So we can see that in November, December or so, there's been a shift. And now all three curves are going lower. If interest rates going lower is not boosting inflation, or at least in this case, inflation expectations, then what we're looking at are expectations of an economic downturn. Then this is not a pure Fed is going to pivot and things will be good kind of story. No, this is instead a story of yields coming off because capital is going into bonds for safety, and inflation expectations easing back as growth slows. That, of course, a consequence of the Fed's actions. So looking at these dynamics over the past month or two, we might say if the NFP number is soft, then we would expect your garden variety, the economy is slowing response, stocks lower, dollar higher, bonds higher, bond yields lower, gold probably not going very far, because again, you have that conflicting influence from lower yields but a higher dollar. Having said that, though, it's not exactly a given, because just earlier today, we saw the ADP report. This is a private sector estimate of payrolls. Full disclosure, it is not very good at actually forecasting what the official numbers are going to be. It's very hit or miss. But again, it's the dynamics that are important. Notice what has occurred here. When you got a number that was 235K versus 150K expected, so a much stronger number, yields go higher. That's the 2-year there. The dollar goes higher. Gold comes down with stocks. So this is the dynamic we saw through most of last year. Let's call it the first 3 quarters. Activated much more by good data means more Fed rate hikes, means more hurdle to economic growth, means more risk aversion, and not this dynamic that's emerged in the fourth quarter where we've cemented around where the Fed is probably going, and that's a June peak in the rate hike cycle, which, not surprisingly, we just saw on these curves that we've been looking at here, right? That's this. And that instead we are focusing on the implications of that tightening, which is this recessionary dynamic that we see here, or at least recession fear dynamic. This was much more textbook. And so there may be a situation as we look at the numbers coming up tomorrow where the initial response looks more like this, but the ultimate response over a course of time, as it is digested, looks more like that. And so that's kind of how we might prepare for what we are looking at in getting ready for these numbers.